warm welcome from me as well. Good afternoon if you're in Asia. Good morning, good evening. We have people watching from all over the world. So over the next 60 minutes, as I said, we are going to look at social bonds. And I hope that if you are an issuer or if you're an investor or some other interested party, you will really benefit from today's discussion. In order to achieve that, I'm joined by a panel of 3 experts that will be able to add a bit of color to our event from an Asia-Pacific market perspective. Now, before I ask my panelists to speak, I just want to set the scene a bit and give you some context. Since 2017, when the Social Bond Principles, or SBP, as they're known, and the Sustainability Bond Guidelines, which are for a mix between social and sustainability bonds, social and green bonds, were published, issuance in both categories has actually increased remarkably. But compared to the growth in green bonds, especially social bonds, have long been green bonds' little less well-known sister, as I like to call it. Now, in the last few months, we have actually read a lot about social bonds in the press. And that is because since February, we have seen a surge in global social bond issuance. Now, that, of course, has to do with the fact that a lot of bonds, as you will know, have been issued to address the corona pandemic. And to put some numbers to that, actually, current global social bond issuance, that is the ones that are aligned with SBP, and I mentioned that because there have also been some unlabeled and self-labeled bonds, already year to date, stands at almost $17 billion US. That's compared to a total of 16 billion for the whole of 2019. Or to tell you in relative terms, just a few months into 2020, social bonds are already making up 17% of the overall green, social, and sustainability bond issuance, compared to a total of only 6% last year. What is important to mention again, though, is that 17% of the social bonds this year have been COVID-19 themed, which means they mention COVID-19 in their use of proceeds. And that's not surprising, given that social bonds are bonds that finance projects that directly aim to address or mitigate a specific social issue and or seek to achieve positive social outcomes directed at a target population. Typical projects funded by social bonds include access to healthcare, access to education, affordable housing, socioeconomic empowerment, employment, etc. So all categories that are appropriate for the current crisis. Another thing is that social bonds, with social bonds, there can often be a debate about what constitutes a social issue and also what is the target population, which is something that you don't have in green bonds, but it often varies depending on the local context. In the case of the current crisis, however, everyone globally agrees that the pandemic is a social crisis or is a social issue, and the target population, just quite generally, is the general population. So looking at Asia Pacific now for our seminar, the numbers are even more impressive. And interestingly, because Asia Pacific has actually lagged behind Europe and the US in the early days of the green bond market, Asia Pacific seems to be leading the way in social bonds. Now let me turn to my panel, and I want to come to you, Helge, first. You have worked on deals in both Europe and Asia Pacific. Would you agree that Asia Pacific could be leading the way in social bonds? And what are some of the trends you see in APAC in terms of asset classes and also structure of deals?
Yeah, thanks a lot, Simone, and a warm welcome to everyone from lovely Singapore. So thanks, Simone, for the questions. Let me maybe tackle them one by one. So the first question was on whether APAC could lead the way in social bonds. And interestingly, that is actually somewhat already the case. I'm a big fan of data, and you already mentioned some data, but if I can just complement that. So my colleagues from ING Research have just issued the latest report on sustainable bonds as well, and a couple of highlights you mentioned. So the total issuance from January to April 2020 of sustainable bonds globally has risen as compared to the same period in 2019 and 18, which is great. If we drill a little deeper, then we see indeed that the green category has decreased a little. Sustainable bonds, which is kind of a blend between green and social, has slightly upticked. And then indeed the social element has really strongly risen, which, as you mentioned, is not really a surprise given that we have seen quite a lot of COVID-19 response bonds, first from SSAs like the African Development Bank or IFC, but then also by various banks. Now, the interesting portion indeed is that so far in 2020, Asia constitutes 39% of that social bond issuance. That compares to 34% last year and 27% in 2019. So here you go. Asia is actually in that subsegment already leading the way. And if you look a little bit strategically into the future, I have no doubt in my mind that given the situation we're in APAC, the potential for social bond issuance is really huge in Asia Pacific. So on your second question, which was more around what themes do we see, asset classes and the likes, I think it's important maybe to differentiate indeed between the current developments because of COVID-19 and then a little bit more strategically looking into the future, because social is of course a broader theme with COVID-19 just being a subset. So you mentioned already a couple of key highlights for COVID-19 themes, which indeed evolve around things like SME lending, which has to do with, for example, income generation or job retention. Then we have the overarching theme of healthcare, which can be increasing medical capacity. It can be R&D into testing, treatment, the vaccines, and so on and so forth. So for example, at ING, we've done the first COVID-19 related covered bond of a bank globally, which was for French CAFIL, which was backed effectively by loans to public hospitals. So effectively providing services in the healthcare system. Another theme that we clearly see is also around social security expenditures. So we've just seen one of the unemployment agencies in France issuing, which I think is the largest global issuance so far. And that issuance was all about job retention. It was about subsidies for short-term workers, etc. So these are a couple of themes. In terms of structuring these COVID-19 bonds, I think that the core question, the first one that comes to mind is, does the issuer already have a social bond framework, yes or no? If they do have a social bond framework, then the next question is, well, is the framework flexible enough? Does it allow me to address the issues at hand of COVID-19, which, for example, evolve around the themes we just mentioned, like healthcare? And if that is not the case, then the option is to expand the existing social bond framework. If the issuer doesn't have a social bond framework, then in our discussions with issuers, we very often come to a discussion around how do we balance, on the one hand side, to go the full 100 yard, meaning we make it ICMA compliant from a social bond principles point of view, we get an SPO, and so on and so forth, versus speed to market. So the issues at hand are pressing. Some issuers don't have time. Markets are a little volatile. So we have seen some self-labeled or COVID-19 themed bonds that are not ICMA compliant, which to some extent is okay, and investors have a certain degree of flexibility. But I think it always comes down to transparency. So if it's not compliant, just state so. But these are a couple of themes that we see. But maybe more interestingly, if you look beyond COVID-19, so what's happening in Asia Pacific? The great news is that there's a whole raft of different asset classes. There's a whole raft of issues from all sorts of countries addressing all sorts of different, for example, United Nations SDG, Social Development Goals. So if I could give you two examples, we did a deal for KHFC, that is a Korean government-owned housing finance company, which effectively addresses the UN SDG 11, which is all about affordable housing. So what they do is they provide financings for low-income families, for vulnerable parts of the population, such that they have access to housing. Another transaction which I personally find very interesting was one where we also structured the social bond framework, which was for India-based Shriram Transport. It's a company that is one of the largest asset financing NBFCs in India. And what they do, among others, is they finance commercial vehicles. So this was all about addressing UN SDGs 8 and 10, which is about decent work and economic growth, as well as reduced inequalities. So for example, granting loans to small entrepreneurs, which again leads to income and employment generation as well. One interesting feature, I think, on that deal also is if you finance commercial vehicles in India, necessarily immediately the question on environmental impact also comes up. So here, that was also taken care of by having certain incentives in place that we have a transition towards more environmentally friendly trucks. So you see from these two examples that there is a whole raft. We've also seen in Australia utilities building pipelines that generate jobs in indigenous communities. There is really almost no limit, a very nice, effectively raft of topics. Maybe one final remark on that point. Today we discuss social bonds, which I think makes a lot of sense because it's a very important and pressing topic. But I think what we shouldn't forget is the challenges of COVID-19 are humongous. And I think what we do need is not a green recovery, not a social recovery, but a sustainable recovery. So I think what I would like to see is not only more social bond issuances in APAC, but generally a growth of the sustainable bond market, because I do think that we need to have a type of nexus thinking where we can't trade off the environmental part versus the social and the other one. Really everything needs to develop, but we see very interesting developments in Asia indeed.
Yes, thank you, Helge. And I think that fits very well with the concept of building back better, which we read a lot about lately, and I think it makes sense as well. Now, Judy, let me come to you. You are based in China. We've just heard a lot about APAC region, but how do you see the social bond market developing there? And also, since early February, we have seen Chinese issuers responding to guidelines for COVID-themed bonds that the People's Bank of China and other regulators issued to encourage companies to tap the capital markets to fund their response to the outbreak. I know some of these bonds are also aligned to international standards like the SBP. Do you see this kicking off a general trend in social bond issuance like we've seen happening in green bonds in China?
Thank you, Samuel. Thank you for your question. Yes, for the China market, we have seen a lot of changes in the first half of 2020. That's how we say 2020 is very unique. So you talk about the green bond. Yes, you can see the China green bond market starting from 2016 to end of 2019, China has been becoming #1 or #2 issuance country in the world. So in 2016, China is #1, and 2017, 18, and 19, China #2. I mean, US is #1. But in general, Chinese issuers already issued over 1 trillion renminbi, including both onshore and offshore market green bonds. So China becoming a kind of like a regular issuance country for green bonds. And most of the green bond proceeds have been contributing to support the green finance development in China, including those projects like, renewable energy, clean transportation, pollutants control, etc. But in addition to green bond, we see that the development of a sustainability bond and social bond are a little bit far behind. So we take sustainability bonds. There are only 2 marked, to be in line with the SBG sustainability bond guideline issued by ICMA. So one is Bank of China, another one China Construction Bank. Both of these 2 banks, they issued sustainability bond in 2018. And these 2 bonds covered green projects and social projects, so 2 parts. And if we talk about the social bond, yes, you're correct. So it's really rapidly developed in the first half of 2020. So we talk about the policy from PBOC. We see that in order to help enterprises and people to overcome the difficulties, on February 17, People's Bank of China decided to provide 200 billion 1-year MIF, medium-term lending facility, of which the interest rate was 3.15%, and another 100 billion for 7-day MLF, for the willing interest rate is 2.5%. So it's worth noting that the 1 year MLF interest rate is 3.15%, which is 10 BP lower than the previous time. So it's a very good encouragement policy. So following by that, so there are many banks and corporates issue the social bond in onshore market in mainland China. For instance, on February 6th, the China Development Bank issued 13.5 billion renminbi of anti-epidemic bonds, and with interest rate of only 1.65%. And also the Export and Import Bank, the Agricultural Development Bank of China, they also issued the bonds for the COVID-19, fighting with COVID-19. So these are three policy banks already issue a total of 21.5 billion renminbi of anti-epidemic bonds. So according to the latest data, so from February 6th to 13th, on China onshore market, the total insurance of 28 bonds exceeds 35 billion renminbi. And from February 14th to 17th, 12 more bonds will be issued. I mean, that was already issued already, and the client size is over 8.55 billion. So these are the onshore market for the social bond. There is one specific bond I would like to emphasize, which is in line with the SBGP social bond principle, to be in line with ICMA, which is one issued by Bank of China Macau branch on February 27. So Bank of China Macau branch issued 4 billion Hong Kong dollar, 1 billion MOP. This is the social bond will be supporting the SMEs in Macau to recover from fighting with the situation. So these SMEs are in different industries, include construction and public works, service industry, wholesale and retail, manufacturing, transportation, and etc. So all of these work contributing by the bank's issuance of the social bond, we see that the efforts have been, really enlarge the population of the job generation in the SMEs. So we also see that not only the banks, but also large-scale corporate companies like state-owned companies and also some medium-sized companies, they also issue the corporate bonds to support fighting with the COVID-19. And I foresee that this will be another good beginning of a social bond development in China, just like 5 years before the green bond market development in China. So in China, actually most of the projects, they will be included as inclusive finance. So even without the COVID-19, most of the banks in China already put a lot of money to provide a loan to SMEs to support them through inclusive finance. So I can see that in the future, social bond will be another very good product for the banks, for the corporates to generate money. And those money will support different industries to generate the jobs, to provide affordable housing, for the education of poor students, and also achieving the UN SDGs. So this will make sure that China will get into the social bond market. So answer your question, yes. Yeah, I foresee that will be a good future.
Okay, great. Thank you. That's a very interesting insight into this big country. And it's also good to hear that you're saying that you're going to see more issuances in the future. Because of course, with COVID-19, the thing is a bit like climate change. It has helped everyone understand it because it's obviously a social issue that impacts everyone because there are social economic consequences everywhere. So it's easy kind of to get around that and agree on that. But hopefully this kind of sad catalyst will also help more issuances in the future. So let me come to Rahul. Rahul, Standard Chartered is an emerging markets bank and a very strong SME lender in countries that are not the focus of some of the larger banks. In addition to structuring deals, you have also issued a sustainability bond, which is aligned with ICMA's sustainability bond guidelines. What I found really interesting about it, though, is that 3/4 of the bond's proceeds go to social projects and just 1/4 to green projects. Whereas usually when you see sustainability bonds in the market, the ratio is the other way around. Can you tell us a bit more about that?
Yeah, sure. So thanks for the question. And you know, we've already had a lot of data and a lot of you know, lively discussion on social bonds. And you picked the, yeah, I think in terms of quoting the Standard Chartered sustainability bond, I think you know, that's a pretty relevant point in terms of why we did it slightly differently versus, you know, the rest of the market that you see sort of a higher weightage to green. So when we planned our issuance, we really looked at what our balance sheet reflects and what we do as an emerging markets leading bank, the kind of geographies that we operate in, and the additionality of our funding that it gets to you know, certain countries which come within the IFC's definitions of MSMEs, microfinance institutions, and SMEs. So when we looked at that, we said, you know, on one side, we do a lot of clean tech financing, and we have increasingly gone out, you know, you might have seen our position statements on coal, our net zero commitments, and as well as our impetus on clean technologies and infrastructure, especially in Asia, Africa, and Middle East. So obviously we do a lot of green financing, but at the same time, I think what we pride ourselves on is in the SME and micro financing segments, which is where I think a lot of additionality is sort of a differentiator of our funding versus you know, some of the more developed markets, which probably are very overbanked at this stage, and sort of one could argue whether, you know, putting a windmill in a very highly developed market versus, you know, financing a small business or a plethora of small businesses and provide employment and of course do no harm in a LDC market, you know, which, you know, where the additionality is humongously or potentially at least higher. So I think when we looked at that, we did feel that the way to go was to give a higher weightage to our SME assets, and you know, when you come to our first reporting date, you will see extensive reporting in terms of the jobs created, the employment created, and the social benefit impacts that we have, not only of this green bond or of this sustainability bond, but the overarching sort of framework of the bank in this regard. So that's you know, something that we advise issuers like ourselves also in terms of when you know, they're posed with the question of, you know, whether to go green only or social only or do a mix. What we tell issuers is a couple of things. Firstly, look at what you actually do as an institution. You know, where is your footing, and you know, what is the basis of your lending if you're a bank, or investments or infrastructure spends if you're a corporate, and then base your bond, the nature of your bond, you know, on that, so that it becomes a lot more sustainable for you to issue and come to market more regularly. So I think my colleagues have talked about you know, the growth of social bonds. I think one or two examples that I would like to take is when we obviously this year we've seen a great impetus to social bonds given the sort of the COVID response theme, where you saw a lot of supranational entities and sovereigns come to the fore and issue under either existing social frameworks or sustainability frameworks, or deals like Republic of Indonesia, which we were again a part of, where you had a situation where you had to come to market soon, and funding and speed of funding was the need of the hour, where Indonesia has actually previously issued green sukuks in the past, but they did not have a social framework, and they had already announced a 24 billion COVID package. So I think from an investor point of view, when we went to the market, we did allude or sort of give the story to investors of the the package that they've announced, the actual funding being directed to COVID purposes. And what we found was there was a good amount of investors who recognized the need for flexibility in these situations, and even ICMA, I think, did come out with a clarification and sort of realized that the need of the hour is really funding and access to funding. So I think that's been helpful, so long as you're very clear that this is not an ICMA. Technically speaking, you're not an ICMA compliant bond, but you're really focusing on the 4 pillars of the social bond principles as you look at allocation, reporting, and so on and so forth. Post that, you've also seen a lot of banks and corporates, Kookmin Bank being another example of Korea, since you're talking Asia, where they had a pre-existing sustainability framework, and they issued a COVID response bond on the back of that framework. I think one nuance that a lot of these COVID loans or investments are actually short term. So they could be about 6 months, 1 year, maybe 1.5 years.
Yeah, Rahul, you keep breaking up. So you're back now. Okay, so I would say let's maybe move on. It's very interesting to have all these perspectives from the market, from an issuer perspective. And Rahul already mentioned a few investors. Now let's talk about investors a bit more. There's clearly a global trend in the appetite for ESG related investments, and some say especially Asia should be a natural choice for investors looking to generate social and sustainable impact. Helge, where do you see most interest in issues from Asia Pacific, and what are some of the challenges you have seen for issuers when coming to, for example, the European market?
Yeah, thanks, Simone. That's indeed a super relevant question. Also a question that we get each and every time when we talk to our clients, being the issuers. As I mentioned, I like data, so maybe some numbers first. If you think big picture, how has the ESG bond investor universe actually developed over the last couple of years? If I look at one number, which is investors that have subscribed to the UN Principles of Responsible Investments, UNPRI, then I think the first statement is that we cannot just say there's a positive trend, that there's more. I would rather call it an explosion. So the assets under management of investors that have subscribed to the UNPRI, and I think we now have more than 3,000 or so signatories, is slightly shy of $90 trillion and has really skyrocketed, which is very good news. As you can see, there's an investor-led effectively demand. Now, if you drill a little deeper, then you see that Asia constitutes roughly 14% of the UNPRI signatories. So that tells me 2 things. Number one, it's a good base, it's a good starting position. But number 2, I think there's more to be done. I remember well, not that long ago, we had a Singapore-based asset manager coming to the ING office for a half-a-day seminar on sustainability with quite a large number of people. Which was great stuff, and we see these types of things, which is great news because it's just anecdotal evidence of a positive development in Asia, but I think more needs to happen. Now, addressing the actual question that you had, which was how do we see these bonds being placed? I think just a generic statement, ESG is always just going to be one decision parameter for investors of many. So there are other issues such as the bond currency or the bond format that also come into play. So if I look at the 2 transactions I previously mentioned, the Euro social covered bond of Korea-based KHFC, we sold 97% into Europe and 3% into APAC. If I look at the US dollar bond issue for Shriram, which was a 144A, as we call it in DCM bond, which allows us to sell into the US, we sold 50% into the US, 37% into APAC, and the rest into Europe. So you can see that ESG is important, but other matters are also important. So what we then have to do is drill a bit deeper into the ESG investor base. So at ING, what we have is a proprietary ESG investor database. I haven't looked at it for a few weeks, but I think we're now slightly shy of 5,000 ESG investors in the database, and we have our own methodology based on which we effectively allocate an ESG score. So how good are they in terms of their ESG commitment. And that database really allows us to provide a service to the issuer by way of looking at the investors in the order book of a normal issue and advising the client on how we see the ESG commitment of those investors. And if there was a tendency to maybe wanting to allocate more to ESG committed investors, we can tell them how we see it and how we would go about it. Now, what does it all mean? Those very, very committed ESG investors are still predominantly in Europe. So there's still a lot that we have to do. I think in Asia, again, we see positive signs, which is great, but there is still a lot of upside potential. And you mentioned challenges. There are indeed challenges. So if I look, for example, at the US dollar denominated sustainable bonds we have done here in APAC, then there is a luxury problem that issuers very often have, which is the Asian investor base knows them very well, and they're very willing to price these bonds very tightly. When we then take them to Europe, many European investors will say, you know what, I kind of like the company. I understand and appreciate the ESG story, so that's good. But quite frankly, it's priced too tightly. So we can't compete with the pricing that's offered by Asian bond investors. So a lot of very strongly ESG committed European investors are priced out, not for a lack of willingness to invest, but really of this pricing paradigm that I see. And I think one thing that is fundamentally important for ESG investors all across, irrespective of region, is really transparency. The very basic principle that we also have in conventional bonds, that if an issuer wants to get credit for something, you have to disclose it. Otherwise, the investor is not able to take an informed decision. And what that means is that, and I'm not saying this because you're the host, but if I look at the work of ICMA, that's exactly what we need. We need standardization, we need transparency, because the investors will want to know, okay, I give you money, what are you doing with that money? And by the way, once you've spent the money, what's the impact of that money? So investors are very, very interested in a reporting on the allocations. They're very interested in a reporting of the impact, which we definitely see very importantly, and ICMA is definitely a good driver for this development.
Okay, thank you. And also thank you for explaining that again. And we see that a lot as well, that investors like that while they're voluntary guidelines, of course, if issuers follow the sustainable bond guidelines or the social bond principles, for example, or for green bonds, the green bond principles, then if they really follow the recommendations in there, then that really helps them to helps the integrity of the product and also provides transparency. Now that leads me nicely to a question for Judy. As we've just heard, the SBP recommends some form of independent external review. And we've already heard about SPOs before. For those of you who don't know what that stands for, is a second party opinion, one type of external review. And how important is that to investors, Judy? Also, something that Helge already mentioned before is that a lot of bonds are mapped to the Sustainable Development Goals, or SDGs. It seems to be a real trend, in fact. Is that something that investors appreciate as well?
Thank you for your question. It's a very interesting topic. Actually, these days I've been talking a lot with investors. Yesterday, I delivered a training of ESG principles and the ESG investment management to the fund managers based in mainland China and Hong Kong. So to introduce how the institutional investors to conduct ESG investment. So for the standardized products will include bonds and the stocks. Right? So how to identify the good ESG performance listed companies and how to pick up bonds from, large number of the bond market, how to pick up the green bond, social bond, sustainability bond. So this is a very technical question because most of the institutional investors, they need to have number one, financial return. Number two, if they are really thinking about the ESG, they need to have environmental benefits and social impacts return, right? So how to improve, how to identify their investment has been contributing to realization of a UN SDGs, and their investment have been contributing to protecting the investment and also to sustainable development. So the third party verification, or we say the independent report, will be very important. So we see green bond principle, social bond principle, sustainability bond guideline. It covers 4 major contents: use of proceeds, project evaluation and selection, management of proceeds, and reporting. These 4 major contents will be the baseline for all of these 3 types of bonds. So for a issuer, before they plan to issue a sustainability bond or social bond or green bond, they need to firstly establish a framework. And the framework will cover what kind of projects they are going to invest, what kind of management methodology they are going to manage the proceeds, right? So how they will report the detailed information. So the framework will be presented to investors to show that this issuer will be fully in line with the SBP, SBG, right? And all of these will require a third-party verification to prove they are in line with the principle, and the internal procedure has been in line with required standard as well. In addition to that, not only like pre-issuance assurance, the more important is post-issuance assurance. So after the bond issued, so the investors need to know the proceeds really generate environmental benefits and social impact. How can they know? They need to get a report. They need to get a disclosure from issuers as well as from the third-party verification. So we take an example like the 2 sustainability bonds issued by China Construction Bank and the Bank of China. So they are post-issuance assurance report will define, for instance, like affordable housing, like how many students have been supported through the proceeds, like how many money has been contributing to job generation. So this detailed figure will make the confidence to the investors they are contributing to SDGs. So this is a good ESG investment product. So taking into that, you see EY has been working a lot on this third-party verification. So as I mentioned earlier, China issued in total over 1 trillion renminbi green bond. Among that, we have been supporting 60% of the 1 trillion RMB, and that's how we have been the #1 third-party verification agency in Greater China area in the last 3 years. And of course, not only in China, I'm supporting my other colleagues based in Asia Pacific countries to, to support the issuers to issue the green bond and social bonds. So I have been talking to many investors, and they are very keen to understand, if I buy this bond, do I really get a return in terms of social impacts, environmental benefits, which I can report to related government or related industrial association to show that I'm a responsible investor. So that's why I see that if we want to further develop social bonds, sustainability bond, and green bond markets in Asia Pacific, even in all the countries in the world, we really need to make sure that the GBP, SPP will be fully in line. And also the information disclosure will be very transparent. The third-party report for both pre-issuance and the post-issuance are very valid. So these will, make sure that investors, they are getting something back they really want. And referring to the UN SDGs, actually, I'm getting involved with UNDP, one of the leading agencies of UN. So we are working out a UN SDG sustainable finance standard, which will be very soon announced on June 5th, next week. So to talk about how to identify the investors' investment will contributing to the SDGs. So we set up a standard, will be announced on the June 5th, which is a International Environment Day. I think that that one will be further, supporting the investors to buy the social bonds, sustainability bonds as a ESG investment products.
Okay, thank you, Judy. That was very informative, very detailed, and I think that was very helpful for the audience. Now, Rahul, you have been involved in some privately placed impact trades, like, for example, the recent Women's Livelihood Bond that Standard Chartered was part of. What were some of the learnings from that transaction?
Sure. So yeah, I think the first thing to point out in that transaction is that till now, if you see the examples that we had taken during the course of this discussion, they've all been large public transactions, public bonds where we've seen effectively issuers issue on the back of their pre-existing curves and having a sort of a strong following of investors, and they've issued typically benchmark transactions of 500 million or more. Now, this was a unique transaction because this was what I would call a typical impact CLO, which is where you had this institution called IIX, which is actually incorporated in Singapore, and their focus is predominantly on women entrepreneurs and supporting women. And the way they do this is really by investing the proceeds of the bond into loans to microfinance institutions who have a minimum criteria in terms of the number of women that they finance and the number of livelihoods that they finance, which have businesses which support women, etc. So there's a long sort of do's and don'ts in terms of the way they select their end beneficiaries. And what's unique is that this is given that this was just a 12 million issuance. But what it really did was that it had support from the USAID, where USAID was providing 50% guarantee on the bond, on the principal of the bonds, and it also had institutions like the Rockefeller Foundation providing a subordinated layer or the first tranche loss piece, if you like. So I think this is a clear case where you can have private investors come into a transaction, bond investors come into a transaction, where you have certain agencies support with first loss or with P&I guarantees on the transaction. So clear case of blended finance to support smaller issuers, where sometimes the social impact is actually a lot larger and a lot more traceable, versus some of the potentially the larger institutions, because in this case the additionality factor is really every dollar that the that they're able to raise is actually invested fresh into projects, as opposed to refinancing existing projects sitting on your balance sheets or existing expenditures that you might have incurred already. So and then if you look at the impact reporting, it goes into a number of pages, despite the bond being a smaller size. Now, what obviously, but the key learnings is the market, while it did support the issuance, when we went to investors, investors were really interested in the story. 45 minutes to about an hour's discussion was really on the structure and how they support the end beneficiaries. Having said that, there was always the sticking point around liquidity that it does not provide as you have in benchmark issuances. So I think investors had to balance the two, and what we did find is that the investors who did come into this transaction, which includes US funds, European funds, and a lot of ultra high net worth private banking individuals across APAC. What we did find is that those who came in and actually took a decent size of the transaction, and they are actually probably accounts who would be interested in future such transactions where with sort of a higher volume. And what I think, speaking to Helge's point earlier, is really in terms of the development of the investor base, we still did see that a lot of the institutional funds were European and US based, we still, I think, need this investor base to grow in our pin code. I think there is some work to get done on that front. And the second thing is, I think increasingly investors will need to look at, sort of smaller impact bonds, private placements. We do have a lot of private placements that happen on the green bond side. But I think where we have some of these unique structures which have a tremendous amount of additionality, I think that's one place where we are getting strong positive signals. But I think we still have a long way to go to develop that. So with the ICMA principles and the various sort of rules and regulations, and you've probably sorted the supply side dynamics. I think the demand side dynamics, which really led the revolution about 12, 13 years back, causing the birth of green bonds. I think we still have a lot of that, in the Asia Pac region. I think we still have some miles to run there.
Okay, thank you very much, Rahul. And as viewers will have noticed, we set 15 minutes for Q&A. We've gone over that a little bit, but then again, I kept an eye on it, and we actually didn't have that many questions because I assume we have already answered a lot of questions. But let me come to the questions you sent now. And the first one I want to take is, what is the panel's view on social sustainability bond proceeds supporting medium and large cap companies with continued viability post-COVID-19? These companies face the same social economic issues as SMEs and smaller cap companies and employ a lot of people, so the risks to economy re their viability are the same as smaller companies. Yes, I think we talked about some SMEs, but we also talked about large companies, and we have seen, of course, the surge in social bonds has been led by multilateral development banks, just like we have seen for green bonds. So we've seen the IFC, we've seen the African Development Bank, and so on. But we have also seen financial institutions, and we've actually seen some corporates, like Danone, for example. So you're right, though, whoever asked that question, there should be more, especially corporate issuers, issuing social bonds, be they related to COVID-19 or any other eligible projects. Hopefully we will see more. If you go to our website, we actually have some case studies that were put together by the IFC specifically for corporate sectors, like, for example, manufacturing and pharmaceuticals, but also for financial institutions. And yeah, hopefully, as I said before, this will have served as a catalyst for people to understand what social bonds are, what they can do a little bit better, and hopefully we'll see a bit more of those in the future. Does anyone else want to say anything on that topic? Helge, Rahul, Judy, briefly?
Nothing much, Simona. I think fundamentally it's all about the purpose. I mean, what is ultimately the impact on the environment or the social area? And that can be a large corporate or an SME, but for me, it's always looking through what is the purpose. So there's no harm in indeed also covering other entities.
Yeah, absolutely.
Yeah,
and we've seen Pfizer. Sorry, Judy,
yeah,
please go ahead.
Please go ahead.
No, I was saying, I think just to add to that list of corporates, you had Pfizer also do a bond to support in their response to COVID, and I totally agree. I think the larger companies eventually, when they fund, it has downstream supply chain impacts on the SMEs and the smaller companies. So I think by default, the proceeds will be applied in manners which impact SMEs, something that we probably a second order, third order impacts that we don't take into account while marketing these bonds. But I do think there's a clear case for the larger companies also to be very much a part of this mix outside of the Supras and some of the other entities.
Yeah, just add one comment. The size of the issuer is not the key point. So not only SMEs, but large companies already issued social bonds in mainland China onshore market. So the key point is the use of the proceeds. So what kind of projects they are going to support, what kind of social impacts they are meaning to receive during the duration of the bond. So that's more important. Yeah, large companies have a lot of opportunities.
Yeah, thank you for those additional examples. And yes, we have actually seen a lot of small ticket items in social bonds as well. Now, I think the next one is one that Helge could take. In terms of pricing, do you see a pricing advantage of sustainability or social bonds over conventional bonds? We of course get that a lot, right?
Yeah, that's an awesome question, because I'm pretty sure Raoul has the same. It's the first question that we get from issuers. So it's actually part of the ING research piece as well that I mentioned at the beginning. So if you read that, there's also a portion on effectively comparing pricing dynamics between conventional and ESG bonds. The short answer is yes, there is a pricing advantage for some sectors, but not for others. So it's very difficult to make a broad brushed statement that you will always have a pricing advantage. What I can definitely say with a great degree of confidence is that you will always have incremental demand. So if you have, and that's a purely theoretical case, if you have exactly the same bond issuance on the same day, one is conventional and one is ESG, undoubtedly the order book for the ESG bond will be greater. But it's not always the case, even if that sounds counterintuitive, that we translate this into a pricing advantage. We do in certain industries like utilities, we don't in certain others. So it really depends. But undoubtedly pricing is, whilst it is a key focus, I think de-risking a transaction by having a larger order book is already also a great advantage of issuing ESG bonds, among many other reasons.
Yeah, I totally agree, and I think this is right from when we used to pitch green bonds in full flow. I think this was the first question that came up in any discussion with any treasurer or CFO. I think and just to add to the point made earlier, when you cut through the order books, the green or social investor base is still a very small portion of the total orders. So effectively, they become price takers from the more conventional counterparts. And then effectively what that means is that it is priced on the back of existing curves and relative value and obviously taking into account current market conditions. So I think probably the number of green specific investors or social specific investors, which creates sort of a captive demand, the greater chances you have for some additional price tension and on the back of additional liquidity, of course. But as I said earlier, I think we really need a lot more work to get done on the demand side of this equation, and that's when I think this question will have probably a sweeter answer to the same question.
Okay, and let me take one more. There's one that asks about, are there any initiatives towards isolating social sustainability green bonds funded businesses or cash flows from the issuer's other businesses for pure investment? And the question goes on further specifying that. What I would like today to say on that, as we've mentioned a couple of times before, there are global standards out there from ICMA, the SBP, GBP, and also the SBG. So the principles, as we call them, and they actually consist, as Judy explained earlier, of 4 core components. And one of them is management of proceeds. And it is actually recommended in there. And that's something that has to do with the transparency that investors like, that we've mentioned before, that you should kind of ring fence the proceeds that you get for those bonds and make it very clear, at least, where these proceeds go. And you should also have reporting on the actual allocation of those reports. Of those funds. So there should be an allocation report, and then later on also ideally impact reporting. So those are all recommendations that you find under the principles. And as I said before, they're voluntary guidelines, but if you want to align your bond with the SBP, for example, then that can also be verified via an external review, which can take different shapes of forms, as we've heard from Judy before as well. Anyone else want to add anything before we come to a close? Okay.
I think it was
just
very comprehensive.
One comment to this question.
Yeah. Just very briefly. 1 minute, Julie?
Yes, just one comment to the question. Yes, so after we do the third party verification for the management of the proceeds, there will be some detailed requirement. So we need to understand, you know, the projects and the proceeds, the linkage, and also how they manage, how the issue manage. They need to have internal control. So there is some detailed information. So usually it's very important for the investor to understand. So we need to report after that. Yeah, just one comment.
Okay, that was brief. So we have reached the end of this event, and I do hope you found this interesting and informative. Be assured, if we haven't gotten around to answering your questions, we will for sure endeavor to answer them in the next few days. We'll get directly back to you. And I also wanted to remind you that a lot of the documents that we have talked about, the principles, the case studies, but also guidance handbooks for impact reporting and the SDG mapping and so on. You can find all that on the Resources Center on the ICMA website. And you'll also be pleased to know or interested to know that in the coming weeks, we will actually update some of these documents. So with that, I want to thank my panelists, Judy, Helge, and Rahul. And thank you all for watching. I'll hope to see you again.
Thank you.
And stay safe.
Thank you.
Bye-bye.